No. All right. So our plan was to do educational webinars for a lot of our audience, friends, family members who have been curious about real estate investing. They've been reaching out to us with questions, and we thought maybe we'll do a webinar series on a monthly basis with a different topic each month. Our plan is to do these webinars last Thursday of every month, unless it's a national holiday. In that case, we'll move it around, or if it's a Thanksgiving Day or something like that. But that's kind of the plan. So we are starting with real estate investing and the fundamentals of real estate investing, really. But slowly we will be getting into more deeper topics like cost segregation, using your 401k funds to invest in real estate, the economic outlook for 2026, because there's a lot of uncertainty in the market. And we like to follow what's going on in the market, what other operators are thinking about, what are some of the indicators they are looking at, and stuff like that. And how does that impact our strategy moving forward? So we'll be doing these webinars, like I said, on a monthly basis. But glad that you all are joining us this evening, and we'll get started here. So first and foremost, before we kick things off, a quick legal disclaimer. This webinar is purely for information purposes and educational purposes. This is not really an offer to solicit any securities, or this is not a prospectus for any of our offerings. So with that legal disclaimer out of the way, we will dive right into the details and the meat of this presentation here. So that's kind of our team here at Prosper Capital. DJ founded Prosper Capital almost about 10 years ago. Andy is my other partner who leads the investor relations. And his responsibility is to make sure that we are keeping our investors in the loop, providing monthly updates, releasing distributions and stuff like that. And I manage the acquisition side of the business. So that kind of includes staying in touch with brokers, lenders, constantly trying to source deals, underwrite deals, etc. And before we all came together, we all had our individual portfolios. So we have done everything all by ourselves right from the scratch. And we realized that we had complementary skill sets. We've known each other for many years now, and we decided to combine our forces and come together under the Prosper Capital umbrella. This is kind of our track record. I'm not going to get into the detail of it. That's not the goal for this webinar. But if you want to refer to it later as to who we are, what we've done, what does our past track record look like, it will be included in the slide that I would be sharing. The only one thing I would like to highlight is we do everything in-house. So that means sourcing deals, managing them, including property management and managing the construction all the way until disposition. So with that, and without further ado, we'll dive into the actual webinar. So the first question that I often get asked a lot is why real estate? Because most people, 90% of people, are actually invested almost fully in Wall Street products. So that tells you that how few people actually invest actively or passively in real estate, because people have some of these limiting beliefs about real estate. And one of them is that it is a lot of work. And a lot of people who have survived 2008 crisis tend to feel that real estate investment is risky. Now, all investment comes with risk, but in general, my goal today is to at least convince a few of you that real estate investing is actually one of the least risky asset classes or investment vehicles you have at your disposal. And there are ways to invest in real estate without actively doing all the work. So if some of you on this call might have prior real estate investing experience, either active or passive, and some of these concepts might be a little bit repetitive, but if you're new, I think you'll find this knowledge quite helpful. If you are already a seasoned investor, then I still really appreciate you supporting us at this webinar. So why real estate? FDR, I think, quoted it in the best possible way. His quote was, real estate cannot be lost or stolen, nor can it be carried away. Purchased with common sense and managed with reasonable care, it is about the safest investment in the world. And one thing that you will notice is some of the most financially successful people in the world have either made their wealth in real estate, or they have made their wealth in a business that they founded, but now they're investing a lot of their hard-earned money in real estate to protect their capital. So if you are thinking about real estate or investing in general, there's no way we can ignore the cash flow quadrant. A lot of you all may have already seen this. This comes from Robert Kiyosaki's book, Cash Flow Quadrant, although the concept has been around for thousands of years. What the cash flow quadrant says is that based on your investment strategies and your professions, everyone can be categorized in one or more of these four quadrants. The first quadrant here is an employee quadrant. In an employee quadrant, you are providing your services to your employer, and it's basically you're trading your time to provide the services, and you're getting paid for your time and, of course, your skills. But the moment you quit your job, you are going to stop making that paycheck. So you're essentially trading your time for money. The next quadrant moving down is the self-employment quadrant. In this quadrant, you don't really have a boss, so you're not working for somebody else, but you still have a job. The difference is you own the job. So who falls in this quadrant? Professionals like accountants, attorneys who run their own shops, or doctors, chiropractors who run their own practices typically fall in this quadrant. So you get a little bit more freedom, but if you take a month off, you're probably going to lose some clients. So you're still kind of trading some of your time to get that money. The next quadrant, moving to the top right, is the business owner quadrant. And business owners, I would say successful business owners or entrepreneurs, they are known to create systems, processes, and developing people to work for them. And that's how they make money. So initially, when they're building the business, yes, they're probably working 20 hours every day. But once the business is built and the systems and processes have been designed and they're working efficiently, I've seen business owners work as little as 1 hour a week and make 7 figures in annual income because they've now built a system that works for them. And finally, we have the investor quadrant, where you are trying to make your money work for you. And this is what financial institutions and banks do. We see a lot of affluent people open banks. Why do they do that? Private banks, because they have already earned a lot of money and now they have this capital. So they just deploy this capital for different projects to buy assets, buy businesses, and they make a guaranteed interest payment without having to put in a lot of work themselves. And that's the whole idea of being in the investor quadrant, is where you are investing your hard-earned money into assets, real estate being one of them, where the asset pays you in monthly cash flow and profits over time without you having to actively spend time managing that asset. So that's the whole idea. So the goal is to go from the employee quadrant, which is honestly where I started. I was an employee for 10 years. But when I started to get a grasp of these concepts, I realized how powerful this is. And I jumped right into real estate investing. And I also have a business on the side, and I do that full time now. Moving on. Now, what are some of the key benefits of real estate investing? Now, the key benefits of real estate investing are multifold, but these are kind of the top 5 in my mind. And folks, I see more and more people joining. Again, thanks for joining. If you could drop any questions in the chat box, we can cover all the questions at the end of this presentation. But since we have only an hour or so for the materials, I'll try to cover all the questions in the last 15 to 30 minutes. So coming back to the key benefits of real estate. So these are kind of the top 5 in our mind. So one is to generate passive income. Now, no income is passive income. Someone has to be active to make that income. However, you always have an option to invest passively in real estate opportunities with other trusted operators who are experienced and have a proven track record. And that way you can invest in those assets while the operators are doing the work, and you get to make that passive income. Number 2 is building resilience during recessions. Now, no asset class or no investment is completely recession proof, but real estate is relatively recession resilient, and especially multifamily real estate, where you're investing in apartment complexes. because multifamily is a basic human need. And we will cover some of that in one of the follow-up slides. And we'll also have our next webinar fully focused on multifamily investing. Number three is tax benefits. And to clarify, this is not avoiding your taxes, but this is tax deferral. And real estate offers a lot of benefits to investors to defer their taxes and get a lot of tax breaks. And the benefit of that is that you're compounding your pre-tax income because you're having an opportunity to defer your taxes, really, if you play the game right, until you die. And then when your future generation inherits your investments or your assets, there is no inheritance tax in the US. So you can actually continue to play this game, not just in your lifetime, but across multiple generations in your family. Fourth is preserving capital. The basic thesis for that is that when you're investing in real estate, you're investing in land, bricks and mortar, and the value of that is never going to come down to zero. So you will at least preserve your capital, as opposed to that, for example, in 2008, if you held stocks to Lehman Brothers, those stocks came down to pretty much pennies. So you can lose all of your capital in stocks. So the chances of losing your capital is definitely there in most of the other investments. But with real estate, the chances of that happening, if you leverage your properties correctly, is extremely minimal. And lastly, it's forced appreciation. Again, appreciation is dependent on market cycles. So if you look at it only from a lens of 2 to 3 years, there may or may not be appreciation. But if you look at it from a timeline standpoint for about 7 to 10 years, typically there will be some appreciation through essentially value add opportunities, which is managing your properties right, bringing in efficiency, and doing some renovation projects at your properties as well. So moving on to kind of now commercial side of real estate. So residential real estate is essentially a single family home, a townhome or a duplex, anything up to 4 units in residential real estate. Everything else, which is 5 units and more, apartment building or office space, a retail plaza, a gas station, a hotel, an industrial complex, all of these are, they come under the commercial real estate asset class. So we look at commercial real estate primarily and not residential, because think about it this way. If you had an opportunity to invest in Google or NVIDIA versus investing in your friend who runs a local, food truck, which company would you invest in? And which company do you think has a better potential of scaling? Of course, the larger one. And that's the whole idea. In terms of scaling your portfolio and scaling investing across that asset class, investing in commercial real estate is the only way you can scale. And there are a few other pros and cons of commercial real estate investing versus single family, which also we will be covering in our next webinar about multifamily versus single family home investing. So within commercial real estate investing, the first question to ask is, how do we determine value of a commercial asset? So with single family homes, the value is basically based on comps approach, meaning if you have a 4-bed, 4-bath home, we will look at all the other homes in your area that are about the same square footage, 4-bed, 4-bath, and what are they selling for? You take an average of that number, and that's about what your property is worth. But in commercial real estate, the value is driven by 3 key numbers, and the math is simpler than high school math. So the first number to understand is the net operating income, which is essentially the annual income produced by the asset minus the annual operating expenses. So what are those operating expenses? Your repairs and maintenance bills, any service contracts, any insurance payments. So all of the expenses related to that property, vacancy loss is one of them, except for loan payments. So NOI does not depend on loan payments, because loan payments can depend on varying different loan terms depending on the market cycle and interest rates. So that does not have an impact on NOI. So once you have your NOI, the next number you need to know is capitalization rate, or in short, cap rate. And cap rate is expressed as a percentage. It is essentially a measure of profitability if an asset was purchased without any leverage or without any financing. So, as an example, let's say if you bought real estate that's worth $100,000, but instead of taking a loan on that property, you paid all cash $100,000 for that property. And if that property produced about $7,000 a year, meaning you got 7% return, that would mean that you bought the asset at a 7% cap rate. So that's essentially the definition of cap rate. Important thing to note here is that cap rate is the best way to compare properties or any asset class. It doesn't have to be residential, any property across multiple different geographical locations. So across markets, across cities, states, and even countries. So it's a good measure to compare properties across the entire globe. And finally, important thing to note is cap rate is dependent on market cycle. It is not an aspect that you and I as investors can control. It depends on market cycle. It depends on the economy. It depends on the interest rates. As the interest rates go up, the cap rates go up. And then finally, also it varies between asset classes. So the cap rate, for example, in a certain market for multifamily versus retail versus office versus industrial might be completely different. So finally, once we know the NOI and the cap rate, the property value is your annual NOI divided by the cap rate. So let's take a quick look at an example of how this works. So for example, if you buy a property that produces $340,000 a year in NOI and the ongoing market cap rate is 6.5, you would take that NOI divided by 0.065, since this is a percentage, and you will get 5.23 million as the value of the property. So it's really that easy. Now, how do we know what is the market cap rate? There are multiple data sources. One of the biggest data sources in real estate is CoStar, or you can just ask any broker that you know, commercial broker, and they'll tell you what is the kind of the ongoing cap rate, but that is kind of dependent on the market, like I just mentioned. So now, having figured out how to calculate a property value in commercial real estate, let's move on to actually what we can do to essentially increase the property value and create returns on our investment. So this is one of the sample strategies, but this is pretty universal. This is called the value add strategy, and it applies to all asset classes within real estate, but it actually applies to all businesses. So if you have looked at how private equity operates, they buy a business, they run it better than the previous operator, they improve the business, they improve the financials, and then they finally sell the business to somebody else. So the same concept applies here. What we do with real estate is we first analyze the market. So that's analyzing the landscape. What is the market doing today? What are the properties trading for? Are the rents going up or the rents going down? Is population increasing, decreasing? What is the job growth like? So there are multiple factors that we look at when we analyze the market. And this is an ongoing process because the market is ever evolving. So you have to look at the market almost on a weekly, monthly basis. Next, you find a property, typically a value add property. You don't always have to find a value add property. If you find a really good property that does not have much to do with value add, but it cash flows really well, that could still be a good investment opportunity. But typically, value add property is where you can actually increase the property significantly and create equity by adding value. And how do we add value? So those are some of the next steps. So next step here is, once you've found that property, is to make an offer on the property, go through negotiations, and get financing approved through a lender or a bank on that property. Once that's done, next step is to go through inspections process, do your due diligence, look at the financials. So there are several documents that you can review, like the rent roll, all the leases, etc. And then also physical due diligence, meaning property inspections, making sure the property condition is in line with your expectations. If it's not, you go back and renegotiate with the seller. And that process typically takes about 2 to 3 months. Again, it could take longer depending on the type of deal that you're doing, but typically for the properties that we acquire, which are apartment complexes, it is roughly a 2 to 3 month process. And then finally, we have 5 to 7 years of hold time. And that's where the real work happens. During those 5 to 7 years, you're constantly managing the property. So you're making sure the residents that you have, if you have a multifamily property, they get great experience. You're keeping up with maintenance. You're monitoring the financials, making sure your NOI is trending upward. So essentially, you're improving the asset financials and keeping a track of vacancy, occupancy, NOI, and several other factors. When your insurance is coming due, when is your loan coming due, when is the refinance going to take place? All of these things happen over 5 to 7 years. And this also includes all the value add renovations that you would typically do to a property. And once all of that is done, at the end of those 5 to 7 years, you typically sell the asset. Now, sometimes if it happens that you're in the worst financial distress or a worst market condition at the end of those 5 or 7 years, the operator might decide to hold that property until the market recovers, until they can recoup their investor capital and produce better returns for their investor capital. So that's kind of the process. Again, if there are any questions, feel free to drop them in the chat box, and I'll try to monitor those questions and address those as they come in. Now, in our opinion, where are the opportunities in commercial real estate today? We think the opportunities today exist in multifamily. Multifamily actually has been pretty slow in the last 2 years. Multifamily saw a drop of 35% in values, which has been the worst ever drop in values in multifamily asset classes history. Worse than 2008, when it was actually about 28% decrease in value. But why am I saying it's a good opportunity? Because it's a good time to buy when the values have compressed. Because now we are seeing a recovery happening in multifamily. The values or the prices have stabilized. The interest rates are holding steady and will potentially come down slightly, not a whole much. But that presents a good opportunity. There is a lot of fear in the market with multifamily because a lot of people have lost their properties for poor planning or poor management, and in some cases, purely due to market conditions. But that has also created a really good opportunity to buy and invest in multifamily, especially with the good operators. So if you have full control and confidence in your operations, this is a really good time to get back into multifamily. The recovery is going to be most likely about 2 to 3 years. But again, because we are looking at a 5 to 7 year horizon, it is a great time to get back into multifamily. Another big opportunity is industrial and flex space. There is a lot of demand for industrial buildings, flex space, which is part of the building is either retail or office, and the part of the building is industrial or a warehouse. And a lot of businesses require this type of space, especially with skilled manufacturing, a lot of it coming back to the US. There is an increased demand for this type of asset class. Now, because this asset class has a lot of demand today, does not mean it will always have a lot of demand, because industrial actually was doing very poorly during the outsourcing era when a lot of the companies were being outsourced and moved to China, especially manufacturing. And similarly, office, there is a lot of opportunity in office today, a lot of distressed office buildings, because in COVID, office saw an average vacancy of over 60%. So office buildings still are trading on for pennies on the dollar. But this is definitely for the brave people who like to gamble, because office has not seen a full recovery yet. So the way we see it is that if we are using investor capital, we would not like to gamble with their capital and buy office building. Also, the other reason for that is because of our lack of experience in that specific asset class. Multifamily is where we play. We are experienced in that asset class. We see the opportunity in that class, and we think it's a great asset to be in, especially today. So another reason why we particularly like multifamily or apartment buildings is, number one, it's a basic human need. If you look at all other commercial real estate, whether that's retail, industrial flex, hotels, they're also needs, but I would call them as business needs. So you need a warehouse for your business, you need a retail space for your business, but you don't need those spaces for survival. But apartments and rental apartments or rental houses, they are really fulfilling a basic human need, which provides it that unique downside protection. Two is cash flow. Of course, all of these asset classes provide cash flow, and there are some asset classes that actually provide much better cash flow than multifamily. But again, you're thinking about this from a risk adjusted return standpoint, and multifamily usually provides a good blend of lower risk and a pretty decent cash flow, typically around 6 to 8% in today's market cycles. Mortgage pay down, meaning your residents and tenants are paying down your mortgage. So you slowly build equity in these properties because they are helping you pay down the principal on your assets. And that's another huge benefit. So in 5 to 7 years, you have gathered quite a bit of equity through mortgage pay down, but also through operational value add. Tax benefits, again, in the brackets, I put in deferral because there's no legal way to avoid taxes, but you can legally defer taxes. Any of you who have been actively or passively investing in real estate for some time know the different ways of deferring taxes. For example, 1031 exchange, or using depreciation and using cost segregation to accelerate that depreciation. So there are a lot of ways, and we will be doing a separate webinar on some of these tax benefits that come from real estate. Next one is hedge against inflation. So typically what we see, not always, again, everything comes with a caveat. Typically, the rents do go up when we see a lot of inflation in the market. So especially, for example, during COVID, inflation was extremely high. And we also saw tremendous rent growth. In most markets, the rent growth was double digits. And now the inflation is cooling off. So the rent growth is also cooling off in most markets. And then finally, strategic forced appreciation, which is kind of what we covered. And that appreciation comes from really three factors. The forced appreciation comes from two factors, which is really operational value add and value add through renovations. And then the third aspect of appreciation comes from just what market cycle you're in. So over time, assets go up in value, and then there is a market crash and they come down in value. So, but we don't count on the appreciation that is provided by the market. We are always banking on the forced appreciation that we can create through value add renovations and operational value add. So I hope everything's clear so far. Like I said, again, if there are any questions, drop them in the chat. The other reason why we like multifamily is just because if we look at the historical data, especially in the US, home ownership rate is actually dropping. And I know this is a little bit of stale data, but this line is continuing to go further down, where interest rates are now up, the home prices have not really come down, and buying a new home is becoming less and less affordable for a lot of people. At the same time, rentership is going up for the same reason, but also more and more people are adopting a nomadic lifestyle where they want to live in one city for 2 years and then move to Austin, Texas, then move to Denver, then come back to the Midwest, go down south. A lot of people want to change their jobs every 2 to 3 years and live that nomadic lifestyle, especially when they are younger. And that is also resulting in a rise of rentership, which is great because that is increasing demand for apartments and essentially rental properties. At the same time, the supply has actually been dropping. If you see how many homes were built, decade over decade, the picture is pretty clear. After the 2008 crisis, the construction starts fell down sharply. It started to pick back up right after COVID when the interest rates dropped. But now, since the interest rates went up by actually 5.25% in 10 months, which has been the highest interest rate increase in the history, construction start has come down to pretty much a standstill. So that keeps the supply to a minimum, and that gives you a really good picture of demand and supply equation. So demand and supply equation is really in favor of landlords. And if you're an investor in rental properties, this really favors you. Now, this equation may change from city to city. So for example, in Austin, Texas, or Dallas, or Phoenix, Arizona, there's actually oversupply. So there's more apartments available than there are people to rent from. However, in some of the other markets like Midwest, we have a completely lopsided equation where we have a lot more demand and very little supply because there's not a lot of new construction coming to these markets. But over time, it all evens out. And typically, if you look at the year over year data, the supply typically is much lower than the demand all over in the US. So the next topic that we would like to discuss is active versus passive investing. This is one of the other questions I get. One of the limiting beliefs that people have is buying real estate means dealing with tenants, nonstop phone calls, repairs, clogged toilets, and all of that stuff and the nightmares that come with owning real estate. However, there's also a way to passively invest in real estate where you actually don't have to do any of those things actively, but you can still diversify your portfolios and participate in real estate investing. Again, to draw parallels with the stock market, the way I think about it is the difference between investing and buying a Google stock as a shareholder versus actively getting a job at Google and being responsible for some of the day-to-day operations at Google. That's basically the difference. If you actively buy a property, now you basically become a business owner and you're responsible for all the operations that come with buying that business, because a commercial asset is basically run like a business. On the flip side, passive investing is like buying a stock in a company. So when you look at active investing, there are, and by the way, there's no right or wrong answer. It all depends on your goals and your personal scenarios. So with active investing, what you really need is a team. So your external team and your internal team. So external team is really your network. And if you're getting into buying large commercial properties, these are all the people at the very least, and there's more that you need to have in your Rolodex. First is contractors or construction companies to do your renovations. Commercial lenders or brokers or banks to be able to get good terms on the loans that you take on these properties. Real estate attorneys, tax professionals, title companies, mortgage brokers, lenders, insurance agents, property managers. If you're not managing the property yourself, you would need good property manager connections, architects, surveyors, environmental studies, and those companies. So this is just a portion of the list of people that you need to know to be able to successfully operate the properties and really operate the business. Because again, like I said, buying a commercial property is equivalent to buying the business. And then finally, you need a really good team internally. And you can wear all of these hats yourself. However, if you're wearing all of these hats, it's going to be a lot more difficult for you to scale. And if you have another job, it would be almost impossible for you to do your job while taking care of all of these things and all of these multiple hats that you're wearing. So the first hat is finding the deal itself. So that's the acquisition side of things. Usually people who work in acquisitions also have to underwrite the deals. So look at the financials. Do the numbers make sense? Is the asking price too high? What should your offer price be? Making sure that you are stress testing the deal and looking at the downside risk and protecting your investment against all of those downside risk. Next is construction and stabilization, which is all of the renovation work that happens typically over 12 to 24 months. And that's, again, pretty much a full-time job. Boots on the ground is essentially a local presence. So if you're buying a property, if you live in California and you're buying a property, let's say here in the Midwest or Texas, you would need a local partner to keep some eyes on the property. That way you're not being taken advantage of by other vendors who are working at your property. Asset management. And asset management, again, is a continuous function where on a weekly basis, you're looking at financial performance of the property. You know, how are the collections? Where's the delinquency at? Are the rent payments coming on time? What's the vacancy looking like? So all of those things factors in to make sure that your asset is actually performing well month over month and year over year, and you're hitting your targets from a net operating income standpoint, and you're actually increasing the property value. Next is capital raise. Now, if you're lucky enough to be sitting on 20, $30 million of cash, you may not have to worry about this. You can go use your own money to buy a larger commercial asset. But if you don't have that kind of money to invest, then you would have to raise that capital from other individuals. It could be friends and family. It could be private investors. It could be, a private equity company. There are multiple sources of capital, but you would have to go and build those relationships to be able to raise capital from all of these different sources. And capital raising in itself is pretty much a full-time job. Investor relations comes into play when you have bought the property, you've closed the deals, but now you have investors to take care of, and you have to make sure you're communicating with your investors at least on a monthly basis, where you're sending them monthly financial reports, a summary of how that property is performing, and then distributions, which is their portion of payments from the profit share on a monthly or quarterly basis. And that itself also takes a decent amount of time. And then lastly, it's the operations and financial oversight. And that's typically done by a financial controller in conjunction with a bookkeeper. So all of those roles, personally, I think it's almost impossible to play all of these roles at once and actually do a good job at everything. And that's another reason why typically, if you haven't built out your own team yet, it might be a good idea to start investing in real estate passively. That way you get to participate in real estate investing, diversify your portfolio, at the same time, learn from some of the seasoned operators if you plan to ever get into active investing in the future. See if there are any questions. Okay, I don't think so. So we'll keep moving on. So the next slide we have here is just to kind of provide you a summary of what passive investing looks like. We are planning to do a separate webinar about active versus passive investing and do a deep dive on this topic as well. But in summary, passive investing, the way it works is you invest your capital alongside an experienced operator or a sponsor. And what that means is these sponsors or operators have been doing active investing for 5, 6, 10, 20 years. And they have initially invested their own capital. They have bought properties, stabilized properties, exited at in a profitable way, and have a track record of actually taking deals this size and this type and actually performing on those investments. So you can invest alongside these investors or operators, and these operators actually do all of this work when it comes to acquisitions, underwriting, value add renovations, operating the property, and then finally selling the property, while you only help with bringing in portion of the capital. Investors become limited partners, and it's the same term that you might be familiar with through private equity investments as well. So this is basically drawing parallels with private equity, where you as an investor invest in that business just from a capital standpoint, and you become a limited partner. And then the general partners are the people who are responsible for operating that business or operating that property, and they're running the day-to-day, and they get portion of the profits, and the limited partners who bring most, if not all of the capital, majority of the equity split. So typically you see an equity split of 70-30, 80-20, 60-40. Those are common equity splits. That way you get to participate in real estate alongside experienced sponsors without having to do the work. And then finally, the returns are distributed, which means the cash flow, the appreciation that comes from exit, which is the profit at the tail end, and also the tax benefits based on your equity in the deal. So if you invested $100,000 out of $1 million, you will get about 10% of the total equity assigned to investors, and you get that proportion of cash flow, appreciation, or the profit at the tail end, and also the tax benefits. Now, typical hold period for these investments is 5 to 7 years. Sometimes it's longer, maybe about 10 years. Sometimes it's shorter, maybe about 3 years. But you have to realize that these investments are typically illiquid. because your money is tied to a real estate asset or a property. The key benefits of investing passively is that it is truly hands off. You don't have to do any of the things that are involved in the day-to-day operations. You get access to larger assets that are more institutional grade. And the reason larger assets are again better is because you have scale, and scale helps you minimize risk. So, for example, if you buy collectively a 100-unit apartment building and 10 of those apartments go vacant, you still have 90 people in there who are paying their rents and your expenses are taken care of. However, if you go by yourself and buy a single family home and it goes vacant, guess who's paying the bills? You are, because it's 100% vacant now. So you kind of limit the downside risk by buying slightly larger assets. I'm not trying to say that larger is always better, but scaling and slightly larger assets are definitely better than putting all of your eggs in one basket and just buying one single family home or one townhome, for example. Consistent cash flow potential, and that's again coming from the rental income collection. If the property is managed right and if it's financed right, you should get consistent cash flow. Now, some of the properties that have a intense value add plan where a lot of the renovation has to happen, that cash flow initially might be used towards renovations. But usually a good operator will never buy a property that does not cash flow. So we are buying really for cash flow. Attractive risk-adjusted returns. And risk-adjusted is really the keyword here, because a lot of my friends ask me that the stock market has produced 20%, S&P average for the last 5 years. And to be very honest, real estate in the last 3 years has not come close to that number. It's around 12 to 13% in average annual returns. But we have to look at real estate and stock market not as real estate versus stock market, but these two are two vehicles, investment vehicles, that should form your portfolio where you get diversification. So sometimes the stock market performs really well. On the flip side, when there might be some correction in the stock market, which most people or economists think that we are overdue for a correction, maybe the real estate might do better during those times. So it's really to diversify and minimize the risk across your portfolio. Most people, like I said, have 90+% exposure to Wall Street products and stock market. And that, in my opinion, is being too exposed to one asset class. Then we have tax advantages, which again, we alluded to in the past. You have depreciation that you get. You can write off any gains you get from real estate, like the cash flow, and you can write that off against the depreciation, also called as the paper losses that you get through real estate. And of course, some of these tax benefits, like I said, are tax deferrals. So they do get caught up unless you continue to reinvest in real estate and you can keep deferring your taxes until you pass away. Professional management with larger institutional grade assets, you also get professional management, and you will have large property management companies, either third-party management companies or operators like ourselves. We have our own management company. We have all the pieces in place, including like maintenance staff, leasing agents, the controller, the bookkeeper to manage our accounting department. So you would have all of those pieces in place. On the contrary, if you try to do all of that yourself, it's typically you who would have to do all of that, have to serve all of those functions. So who is passive investing great for? It's great for someone who already has a full-time job, a busy job, who wants to get into real estate investing without the active involvement, and prefers really a predictable income rather than investing in certain speculative stocks. Because with these real estate assets, typically the cash flow starts either immediately or after about 18 months or so after the value add renovations are done. And that cash flow payments usually come in like clockwork on a monthly basis. And then finally, people who value diversification and scalability. So if you feel uncomfortable having too much of exposure to stock market, this might really be a good investment vehicle for you all. So I think that was really mainly the content I wanted to cover during this webinar. investing in real estate and fundamentals in real estate investing actually can be a 1 week workshop in itself, but this really gives you an idea of the basics. In some of the follow-up workshops, we are going to talk about topics like multifamily real estate investing. What are the benefits? And what does that look like, especially in 2026? Using 401ks and SDRAs to invest in real estate. Like I said, state of the economy, what is the market doing today? And where do we foresee the market going in the next 2 to 3 years? Tax benefits, so on and so forth. We will be doing these webinars once every month, last Thursday of each month, around 8 p.m. Eastern. That way, folks on the Pacific Coast can also join in. And that's basically it, folks. That's my contact information. Feel free to reach out to me anytime. I love talking to people and especially helping people start on their real estate journeys and even otherwise. I just enjoy speaking with people and getting to know people. So if any of you haven't spoken with me yet, I see most of you I do recognize. Please feel free to use my Calendly link and let's hop on a Zoom call. But thank you again so much for joining us this evening. I know it's late in the evening for a lot of you all. I wanted to respect your time and try to wrap this up by 9. And I think we are a little ahead of schedule. So I can open this up for questions if you all have any questions. Let's see here. No questions. That's not a problem. I hope no questions because I did a good job, or maybe I went too fast and nobody followed anything. And if that's the case, use my Calendly link, schedule a call, and I would be happy to go over all of this with you on an hour-long conversation. Again, thank you folks for joining. We really appreciate your time. Enjoy the rest of your evening, and we'll see you at our next webinar. Thank you and good evening. Bye-bye.